You ever ask yourself what's the best income ETFs for retirement? Well, today we're going to give you the 5 best income ETFs for retirement income for 2026. We can build income freely, live freely, retirement with confidence, all working off of really only these 5 simple funds across the board. We're going to break them all down today for you and give you the insight of where I personally put them, how I rank them in our three bucket portfolio. Hey guys, it's Doug the Retirement Guy. Welcome back to the channel. Let's get into today's video to give you a good rundown of the 5 best income ETFs. Before we do, we got to give you the important disclaimer. This content is for educational and entertainment purposes only. This is not financial advice, and past performances do not guarantee future results. Now, before we get deep into this, I got to do you the retirement made easy, living on dividends, entire coffee mug, drink packages. Guys, we do this to support the channel. We ask you just a little bit. We don't ask for advertisers. We don't go out and do that game. We want to stay unbiased in the whole process. So what we do, how to support the channel, because it does cost money to produce these videos and to put the screens on like we have, we came up with a whole simple, you get something and it helps support the channel. We sell coffee mugs with our logo onto it, 11 ounce, 15 ounce, easy to get, QR code. You can do the link down below. It just helps support the channel across the board. So as I always say, grab your favorite mug, pour your favorite beverage into it, sit back and let's learn about finances. So as I talked originally, I personally have always followed what I call the 3-bucket retirement system. It's a portfolio system that's easy to explain. It's easy to digest. It's easy to put the whole together. We got bucket 1, which is I call foundation. Now, a lot of people call it safe, stable. I call it my foundation fund. That's what you build off of. This is going to be where your cash, your short-term investments all go into bucket number 1 so that you can sleep at night. Bucket 2 is for growth. And that's the growth, the compounding, the building of your portfolio. Even if you're in retirement, even if you have enough money saying, I'm done, retired, I'm all set, you're still going to need growth because of that nasty word called inflation. Okay? Inflation right now running about 3.5%. So your funds better be growing. Your whole portfolio better be growing at that 3 to 4% range just to stay ahead of the dollar shrinkage. Now, this is going to be some stocks, some growth investments, and so on. Now, bucket 3 is the one that everyone always talks about and loves, and that is the income bucket. This is the income, your cash flow. This is your freedom bucket. This is the one that's going to give you your money that you can go live freely. I've been doing it for 10 years. Seriously, I've been living on retirement. I've been living off of dividends for well over 10 years already. So it's made it simple, it's balanced, and it's built for life. So let's take a look at what the top 5 is. That would be in the bucket income. So how did my rankings really work? So I want to be upfront and tell everybody honestly how we do this. One is we look at the reliability of the distributions. Because if you don't have reliability in distributions, you really don't have any income. We want to look at the total return to find out, is the fund really stable or is the yield that they're giving us fake? Because you got to remember my golden rule. Yield tells us how much the fund is currently distributing. Total return tells us whether the investment is actually creating or destroying wealth. We want to have diversified strategy. We want a reasonable expense ratio. And we want that NAV erosion protection. Now, the 5 essential roles that a fund will have to be put into is what we call the broad income core. This is the core of the income. This is the main driver of the point. Next, we want a lower volatile income. We don't want something bouncing all over the place. We want lower volatility. We want growth and income, and we call that a satellite. So if you have another fund that has some income, but also is creating growth, we put that in the satellite edition. So you got core and then the supporting act of the satellite. Now we want to make sure we got dividend growth as well. We don't want just the thing, starting off at paying us $1 a share and it's going down to 50 cents a share, or 50 cents a share, and we would love to have 50 cents a share and climbing up, but we just want to make sure that we're getting some kind of growth, normally with inflation. And then we also want to have a fixed income type dividends across the board. So SPYI, the NEOS S&P 500. The best overall retirement income ETF. I truly believe that this is number one in my book. I do this a lot. And the reason why I say number one, first off, S&P 500 is a very, very strong complex. They hold the top 500 companies out there. They do what really works well. They have their own history. It's been out there for years. But what NEOS does so well with this one, first off, the distribution rate, 11.99%. Now remember, I don't follow the yields at this, but I know 11.99, solid income. The 1-year total return, 18.97%. So that's talking about a 6%, almost a 7% growth rate adding to it. So that's well above the inflationary rate. Expense to carrying it, 0.68. Pays out monthly scheduling. The NEOS S&P 500 High Income ETF combines a broad U.S. large cap exposure with actively managed index option strategy to generate those high monthly cash flows. Okay, the tax efficiency of NEOS is unbelievable. Now, you may be in an IRA, you may be in a Roth, but overall, if you end up in a brokerage fund, this is where you're really going to be living in. Because they do the SPX index options, they receive that 1256 tax treatment, which is 60%, 40% long-term, short-term capital gain side of it. So they're giving you the lowest possible tax rates right off the bat. They also employ tax harvesting and ROC, return of capital, on their distributions. So they try to minimize the amount of taxes that you end up paying across the board. Now this is, to me, is a core monthly income holding with the high total return potential. This is my core in my third bucket, income. I break it down to S&P 500, NASDAQ 100, and I do the Russell, all as my core sectors. Then I also do a international part, and then I have what I call a discretionary side, which is my REITs, my BDCs, some weeklies I'll throw in there. So these are the pieces of it. So this one is my core piece inside my S&P 500. So why it ranks first? Well, there's a lot of different reasons. And the first one, of course, is going to be the yield at 11.99%. But the next thing that always supports that yield is that 1-year total return at 18.97%. And then when you take a look at the carrying expenses of 0.68%, it just makes it a very solid number-wise, very, very strong. Now we have a broad S&P 500 base. We have an active option strategy going after the SPX index, and we have a total return potential that combines double-digit yield with price appreciation. So it's really that retirement paycheck doesn't erode the principal. So SPYI earns the top spot by being a balanced income, diversification, and growth, a combination that makes it a premier core holding for 2026, and I really think 2026 and beyond. So when I rank my stuff in my growth bucket, it's always an S&P 500, a NASDAQ 100, a Russell 2000, and then I get the international. And then normally another sector that I'll use that if it's energy or just a combination of little things. But primarily in the S&P 500, I want a core. I want a core piece that I invest into, and then invest into what satellites that will help support whatever I need. Maybe a little more growth, maybe a little more income across the board. Now, number 2 is JEPI. This is the JP Morgan Equity Premium Income ETF. It targets monthly income with less volatility than the broad large cap market. Now, I want to put an asterisk already. Just because I put this at number 2 does not make it number 2 as a whole or as a total. This is the fund you buy. I personally have a love-hate relationship with JEPI. But I put it out here for a reason. That there's a lot of conservative investors. There's a lot of people that are into retirement that just want the smoother ride into the retiree and the conservatism of a retiree. Now, this one here, the reason why I say asterisk, I love and hate, and I'll explain to you as we go along here, The 30-day SEC yield is 8.20%. The rolling yield is 8.06% over the past 12 months. Now, this is where a prime example of my total return comes into, right? You're getting 8% return. Sounds like a great number. 1 year total return is 7.77%. So the total return is less than the yield, which means you're not getting the full 8%. So how does this make number two? Well, the problem that you run into is JEPI has that lower volatility. It's looking for lower action in the stock market, in the funds that it invests into. And this is what's happening is the market is outplaying what JEPI has and always liked. So they're not performing as well as we would like to see, and that's why we're seeing a drop off in the growth of the fund. But even though JP Morgan is still one of the strongest players in here, that conservatism is hurting people down the road. Now you get the expense report as 0.35%. That's something low cost carrying charge. Well done. Now the primary risk here is the underperforms in the powerful growth markets, which is what we've been into, is it underperforms. Income is typically taxed at ordinary income, and ELNs introduce counterpart and liquidity risk. So lower volatility does not equal principal protection. So there's multiple pieces in that sentence that we just used, and the big one there is it underperforms in powerful growth markets. Now, the cash flow with a different trade-off is, we talk about this. The lower volatility focus actively seeks stock portfolio designs to moderate the ride. So they're looking for a rough ride. So they're doing things that will basically be cruised, just dial in for a longer, smoother ride. There's a lot of people who have talked to me about this. The ELN structure generates monthly income with the equity-linked notes alongside their dividends. So they're getting a mixture of both pieces. And it's a very conservative choice. Now, that critical trade-off is that upside protection, which is what we're seeing is the lack of, and the tax efficiency of it. So even though it's number two, I don't put this as a high level unless you're in that conservative market or looking for conservative marketplace. At number three, QQQI becomes the best income and I believe the best growth package in the funds. Okay, so the NEOS NASDAQ 100. Now, I'm not a NEOS supporter. I love NEOS. Let me just say that. But I'm not sponsored by NEOS. You know that because of the coffee mugs. I don't do that kind of things. But NEOS just keeps giving me so many reasons to talk to them about. It pairs well with the major tech exposure and the high yield income across the board. It gives you that monthly distribution, gives you those tax advantages with that 1256 and that active tax harvesting and the ROC. So this thing works great when you're in a brokerage type account. When we look at the numbers, 14.05% distribution rate, and then look at the total return off of 1 year at 25.70, you're talking about 11% in growth and about in the 14% of income. So you got the best of both worlds here. So the annual return since inception is averaging 21.5. So it's getting a history of doing this over and over and over. Carrying cost 0.68% as usual. Now this one here, again, the positives to it is that growth potential in the high exposure of the NASDAQ 100 tech. The tech's been on fire for a good 5 years already. It's been very, very strong. And they have that premium harvesting using that NDX index. So they have the NASDAQ 100 in a portfolio, plus they're doing the NDX index overlay. So the concentration in tech that leads to higher volatility is the real risk that we deal with, and it has a higher volatility than SPYI or JEPI. So it's one of these things that's a powerful controlled satellite for retirees who can tolerate tech lead risk to capture upside potential. To me, I always say it's not suitable of a core asset stability if you just want to say, I want to retire only on QQQI, not there. But I really say in my portfolio bucket, if you turn around and put QQQI as a core for the NASDAQ 100, I think you really have a winner across the board. Now, the inflation fighter. This is another area that people start talking about, inflation and fighting the growth. SCHD. It's probably one of the best dividend ETFs and growth ETFs that are out there. Now, don't let these numbers fool you, because something with SCHD is you need long time. This is a long-term engine for future wealth. The 12-month yield, 3.3. Okay. When we get into the expense ratio carrying this, that's almost for free. It's 0.06, which basically means that's $6 coverage on a $10,000 investment. They use about 103 different holdings, and they're very particular what they pick on this. The core growth is targets at high quality companies with sustainable dividend tracking records. Inflation protection designed for increased future income through dividend hikes, capital gains, and then, of course, the low cost of carrying of the fund. Now, that yield gap, SCHD may provide enough immediate cash flow for retirees requiring that 8 to 10 distribution, because along in the growth, this one belongs in the growth bucket or a dividend growth sleeve. It's not a primary paycheck. So this is not one I would put in my 100% put in my income fund, but it goes in the income talking that we're talking about, because if you hold this for long periods of time, if you take your yield plus the growth and all that 5 years, 10 years down the road, you'll actually end up being an 8 to 10% yield out of the program. So that's why I say SCHD is a long-term engine for future wealth. It prioritizes quality over maximum yield, making a premier choice for fighting inflation in a 2026 portfolio. So I always say this one: if you're getting close to retirement, or you're maybe 5-10 years out, I'd start putting money into this one that prepares you for long-term down the road. So this is where it comes in. Low yield today, potentially more income tomorrow. Because it isn't built for the highest current yield, the target's quality dividend paying companies with strong fundamentals to ensure income grows over time. So that's the key factor. You're going to continue to grow your income. It's like planting a seed. You plant a seed and it slowly grows and gets bigger and bigger. That's what this does. So what I always say here, the portfolio role, retirees should distinguish between paycheck bucket and their growth bucket. And SCHD belongs in that growth sleeve, either in the income bucket or their actual growth bucket itself. Now, number 5, BNDI. This is the best fixed income diversifier. NEOS, again, enhanced income aggregate bond ETF fund. The bond fund exposures and adds options strategy intended to increase monthly income. It invests in U.S. aggregate bond ETFs and sells SPX put options. So this is the opposite of what it does in the S&P 500, still using SPX to generate its income. Distributions 5.8, trailing distributions 5.88 over 12 months. So you can see very steady across the board. 1 year total market return 5.27%. Expense ratio 0.58, and this has been capped all the way till May of 2027. So what makes this one so great? Diversification does not mean risk-free. Bonds provide, or BNDI provides income and diversifiable role distinguished to pure equity income funds. But investing through aggregate bond ETFs is adding the SPX put premium. It functions as an enhanced income tool, not a safe bond fund. So it's kind of give you bond with a bonus, I call it. So it makes the numbers look very, very strong. Plus, it uses strong tax advantages, which is common with a lot of NEOS funds. Okay, BND can complicate a portfolio's fixed income allocation, but it's an active strategy that carries quality overlay risk and review the final tax report rather than treating every distribution as a standalone yield. So overall, this one helps you in your tax purposes as well. So the stronger retirement portfolio structure, as I've said originally, your foundation is your cash reserves, short-term T-bills. It's the peace of mind that you let you sleep at night. Income bucket, your core right off the bat, SPYI. Then you can always put JEPI as a conservative satellite type piece, and BNDI as your diversifier. And then your growth fund, this is where we get a lot of people comment to me and argue back. There's multiple different ways of building this, but Charles Schwab, the SCHD, is the quality in the growth side. QQQI is your satellite because you're going to want to take some of that income, put it in the income bucket, and then you want NAV protection across, and that's what these 5 funds give you as a total run across the board. So the final ranking on retirement, yield is the math number. I've said that numerous times. Substantial total return and retirement roles dependent on the durable plan. So you need to put this in that 3-bucket system, use it accordingly, and I think you'll find out that the reason why I put these in the categories that they've done, that each one of these fit perfectly in the spot that we suggested you put. So let me know what your thoughts are. I know there'll be a lot of opinions. Where's Goldman Sachs and where's all the other ones? Well, leave a comment down below. But understand we're using this inside that 3-bucket system for a particular reason. Let me know your comments below. Hit that like button. I appreciate it, and we'll catch you out next time.